So let's dive on in. This month's inflation report showed that annual US inflation fell to its lowest level in more than a year. This is a further sign that the price pressures have peaked amid the Federal Reserve's historic campaign to tighten monetary policy. The rate of increase in the Consumer Price Index is of course published each month by the Bureau of Labor Statistics. This marks a sixth consecutive monthly decline, registering a now annual increase of just 6.5%. While still higher than pre-pandemic, this was the lowest level since October 2021 and represents a notable decline from the 9.1% reached in June. Compared with the previous month, prices dropped just 0.1%, but that is certainly in the right direction. Fed officials are monitoring the latest inflation data as they decide how much more to squeeze the US economy. Having stepped down to a half-point rate rise last month, following 4 consecutive three-quarter-point increases, our central bank is considering whether it can revert to a more typical quarter-point speed at its next policy meeting in February. Optimism around this news has reflected in consumer rates as well. According to Freddie Mac, the 30-year fixed-rate mortgage is averaging 6.15% in the week ending January 19, down from 6.33% the beginning of the month. 1 year ago, the 30-year fixed rate was 3.56%, however. As we know, mortgage rates rose through most of 2022, spurred by the Fed's unprecedented campaign of harsh interest rate hikes to tame soaring inflation. But mortgage rates dropped in November and December, following data that showed inflation probably has finally reached its peak. However, mortgage rates are expected to remain volatile until the Fed's rate hikes end. How are the average mortgage rates figured by Freddie Mac? Well, it's based on mortgage applications that Freddie Mac receives from thousands of lenders across the country. The survey includes only borrowers who put 20% down and have excellent credit. Many buyers who put down less money up front or have less than perfect credit will probably pay more than the average rate, but it's a good benchmark to observe for trends. Keep in mind, the Fed does not set the interest rates borrowers pay on mortgages directly, but its actions certainly influence them. Mortgage rates tend to track the yield on 10-year US Treasury bonds, in fact, which move based on a combination of anticipation about the Fed's actions, what the Fed actually does, and investors' reactions. When Treasury yields go up, so do mortgage rates. When they go down, mortgage rates tend to follow. Sam Cater, Freddie Mac's chief economist, says, while mortgage rates have resumed their decline, the market remains hypersensitive to rate movements, with purchase demand experiencing large swings relative to small changes in rates. Over the last few weeks, latent demand has been on display, with buyers jumping in and out of the market as rates move. Now, our office has seen buyers begin to return to the market. In fact, the US housing market continued showing signs of normalizing in December, with inventory and time on market increasing, listing price growth moderating, according to a report from Realtor.com. In fact, Danielle Hale, chief economist for Realtor.com, says prices are still significantly higher and homes are selling faster compared to 2019 pre-pandemic levels. While the number of homes for sale continued to increase in the latter part of 2022, inventory is still significantly lower than it was in 2019 before the pandemic. Home sellers also continue to be less active in December, and fewer listed their homes for sale as opposed to a year ago. But nonetheless, homes still sold faster in December than was common in 2019, with more affordable, lower-priced markets in the Midwest and Northeast seeing homes sell faster than in other areas. In December, the typical home spent 67 days on market, 11 days longer than last year, but still 16 days faster than in 2017 to 2019 on average.
Welcome back to the Consumer Corner. Today we have tax-related news. Normally not the most fun topic, but it's about one of the more historic moves in property taxes in the great state of Texas. Governor Abbott has made it well known that Texas has had a very profitable past few years, and now has a budget surplus of just over $27 billion, not including the Texas Rainy Day Fund of an additional $13.5 billion. There has been hot debate on how to use these funds, but he has reminded us Texas that this money is ours, and we should reap the benefits of contributing to the Lone Star State. Along with addressing well overdue infrastructure updates, Governor Abbott plans to make massive cuts statewide on property taxes to alleviate the stress on homeowners as the recession takes hold. Additionally, hoping to keep the move to Texas strong and have reoccurring surpluses. As of now, these plans are in their infancy, but should take some form by the end of 2023. The two biggest methods laid out will be through changing policies on special district taxes and school taxes. The plan with schools is to use any surplus funds to compress the cost of school district maintenance and operations, which is typically the largest part of any taxpayer's property taxes. For example, in Dallas County, the Dallas ISD tax is 1.185%. That's half of citizens' property taxes. The objective is to use whatever surplus would have been earned by those taxes will be the amount to be reduced on the rate, with the end goal of leaning on the state sales tax to handle schooling and eliminating or at least greatly reducing the amount counties need to tax to adequately maintain and develop their school districts. The second method of alleviating taxes is focusing on special district taxes. Special district taxes are for major city repairs, hospitals, road maintenance, and whatnot. And the plan is to drop and limit increases in those tax rates through the voter approval tax rate limit. This is the amount officials are allowed to change taxes by without needing to get voter approval. Currently, it's set at 3.5%. If all goes to plan, the goal is to drop it to 2.5% or maybe even something less. For those to take effect, there will need to be a vote in the Texas Congress, and as soon as those new rates take effect, we can only imagine the boom Texas real estate will have. Happy shopping out there, y'all. See you next time in the Consumer Corner.
Excellent. Thanks so much, Alex. Home sellers are competing to grab the attention of the buyers that are in the market. As such, the tables have been beginning to turn. Home sellers gave concessions to buyers 41.9% of the time in home sales that happened in the fourth quarter of last year. Concessions increased over 30% in the previous quarter and the fourth quarter of 2021. A record 22% of home sales in the fourth quarter included both a concession and a final sales price below their listing price. You can see why buyers are starting to enter the market. And part of the reason this is so available for home shoppers to take advantage of is that sellers have built up so much equity over the last couple of years that they can actually afford to dole out sizable concessions. Van Welborn, a real estate agent in Phoenix, put this nicely. Buyers are asking sellers for things that were unheard of during the past few years. They're feeling empowered, partly because their offer is often the only one, and partly because they know sellers have built up so much equity during the pandemic that they can afford to dole out these sizable concessions. Welborn goes on to explain how he recently helped one buyer negotiate a $10,000 credit for a new roof on top of a handful of other repairs. They originally asked for $15,000, but settled for $10,000 because the homeowner also agreed to sell for less than their asking price. Not every home seller is easily adjusting to the current market, though. Across the U.S., real estate agents are having difficult conversations with home sellers who can't quite accept that they won't get the same price a neighbor of theirs did just several months earlier. Realtor.com data confirms the seller's worst fears, with the median national list price declining from an all-time high of nearly $450,000 in June to $417,000 in November, according to their most recent monthly report. What's more, the share of listings with price reductions grew from 9.4% in November to 19.6% now. It's just really hard for sellers to adjust to this market, and we have sympathy for that. Sellers are setting their expectations based on the things they've seen, but that's not the reality anymore. Conditions are different now, and it's probably better for you to accept that when your real estate tells it to you, rather than learn it the hard way by having your home sit on the market for longer than you expect. Because the longer your home sits on the market, the more reluctant buyers will be to take a look, and the cycle just spirals downwards from there. Real estate agents often act as therapists for people getting ready to make one of the biggest financial moves of their lives, and the upheaval of this market calls for some serious counseling. That's all for this month, my friends. I'll see you next week.